All right, today we are cracking open one of the market's most watched and honestly most misunderstood signals. It's a ratio that you see flashing on countless trading screens, but you know what? Most people are reading it completely wrong. We're going to fix that right now. I mean, that's the holy grail, isn't it? The one question every trader asks. Is there a single magic number that just flashes bright red right before the market takes a nosedive? A secret signal that screams, get out now, or maybe even, it's time to buy. And a whole lot of traders believe that magic number is hiding in the relationship between two key volatility indexes. But here's the catch. The common way people interpret this, it's just too simple. And because of that, it's often flat out wrong. So today, we're going to uncover the smarter way to read the market's so-called fear gauge. Okay, first up, the one you've definitely heard of, the VIX. Everybody calls it the fear index. All it does really is measure what the market thinks S&P 500 volatility is going to look like over the next 30 days. You can think of it as the market's pulse, its heartbeat for immediate short-term anxiety. Now, let's meet its less famous, but I'd argue equally important sibling, the VXV. This index does the exact same thing as the VIX, but it's looking further down the road. It measures the market's expectation of volatility over the next 3 months. So this is the market's medium-term outlook on risk. So here's the absolute key to all of this, the time horizon. VIX is all about the right now, what's happening in the next 30 days. VXV is about later, the next 3 months. One is a snapshot of immediate panic, while the other is a forecast of future concern. And trust me, that distinction is everything. So when we take VXEXV and divide it by VIX, we're not using some kind of mystical formula. Nope. We are simply measuring the steepness of the market's fear curve over time. It just tells us how much more risk the market is pricing in for the future compared to what it's worried about today. And it really breaks down into two states. When that ratio is above 1, it's a state called Contango. This is the normal, healthy state of affairs. Think of it like buying insurance. Insuring your house for the next 3 months is, of course, going to cost more than insuring it for just the next 30 days. That makes sense. But when the ratio drops below 1, we enter backwardation. This is panic mode. The fear of what's happening right now is so intense that immediate insurance becomes way more expensive than future insurance. And this brings us to the big myth, the big trap. A lot of traders learn this one simple rule. When the ratio gets really high, let's say above 1.3, it means the market is way too calm, way too complacent, and a big crash is just around the corner. So you sell. Sounds easy, right? Well, it's a little too easy. And as our source material puts it pretty bluntly, that idea is just far too simplistic to be reliable. Blindly following that rule is a fantastic way to get yourself into a world of hurt, probably selling way too early in a strong, rising bull market. So why does this simple rule fail so badly? Well, there are 3 big reasons. First, the market environment, the regime, matters a ton. A ratio of 1.3 means something totally different when interest rates are high versus when they're low. Second, these high levels can just last. The market can stay complacent and keep grinding higher for weeks, even months. And finally, and this is the big one, the actual number, the absolute level, isn't the real signal. It's the speed of change, how fast that ratio is moving. That's way, way more important. And that right there leads us to a much smarter approach. We have to stop trying to use this ratio as some kind of crystal ball to predict a crash. It's not. Instead, we should be using it to figure out when near-term risk is being mispriced, because that creates some really interesting strategic opportunities. This all builds into a really actionable framework, which we can break down into 3 strategic plays for 3 totally different market conditions: how to act when the market is way too calm, how to navigate an all-out panic, and how to confirm the market's underlying health. Okay, let's talk play number 1. The ratio is sky high, above 1.30. The obvious, simplistic thought is, oh my God, sell everything, the crash is coming. But the nuanced, smarter strategy is to think, wait a minute, near-term volatility is historically cheap right now. It's not a signal to sell the market, it's a signal that protection, insurance is on sale. This is what's called the cheap convexity play. Now, don't let the fancy term scare you. It just means you can get a lot of potential upside for a very small cost. You're not trying to be a hero and predict a crash tomorrow. No, you're simply taking advantage of the mispricing by buying that insurance policy, like short-term options, at a huge discount. It's a strategic move, not a prediction. All right, on to play number 2. The market is in a full-blown panic. The ratio has cratered below 0.90. The obvious thought here is to be a hero, right? To bet against the fear, sell volatility, and try to catch the absolute bottom. The smarter strategy, just wait. Patience is your greatest weapon here. The real signal is not the panic itself. Doing this helps you avoid what's called the mean reversion trap. Trying to short volatility too early in a real crisis, well, they call it a widowmaker trade for a reason. That panic can last a lot longer than you can stay solvent. So the key insight here is to wait. Wait for that ratio to climb back above the 1-point line. That's your all-clear signal. That's what tells you the worst of the immediate panic is probably over. And that brings us to play number 3, for when we're in a normal market, where the ratio is just kind of stable. The obvious thought is, okay, everything's fine, the trend is my friend. But the smarter strategy is to look a little deeper for some hidden warnings. And to do that, we need to introduce one more index, the VVIX. So what is VVIX? It actually measures the volatility of volatility. Yeah, I know. Think of it as the anxiety of the anxiety index. If our main VX VVIX ratio looks calm and stable, but the VVIX starts to spike up, that is a massive warning sign. It's telling you that the big institutional players are quietly buying up protection, betting that this calm isn't going to last. For you, that's a signal to get more defensive, maybe tighten up your stop losses and reduce some risk. And here's where it all comes together. This is the operational cheat sheet, the pause the video slide. We can literally translate the ratios level directly into the market's psychology and then decide on a strategic posture. This is how the theory becomes a practical playbook, from buying cheap hedges when everyone else is complacent to patiently hunting for bottoms when everyone else is panicking. So if you take just one single thing away from all this, let it be this incredibly powerful insight. You shouldn't fear the high ratio. That's Contango, that's the normal state that actually fuels bull markets. You should fear the flattening, when that high ratio starts to fall, and fall fast. Because that, right there, is the ultimate takeaway. The most predictive signal isn't some static number sitting on your screen. It's the rate of change. It's the speed at which that complacency evaporates and the smart money starts bidding up the price of near-term protection. That's your real warning sign. And that leaves us with one final question for you to really think about. After all this, are you still going to be watching for a simple, static number to tell you what to do? Or are you going to start watching the change, the flow, and the real story the market is actually trying to tell you?